All right, let's talk about Paramount Skydance, because their latest earnings report is a fascinating story. It's really a tale of two companies. On one side, you have their streaming service, which is absolutely soaring. But on the other, their traditional businesses, well, they're kind of in a nosedive. So today, we're going to unpack all this conflicting data and figure out what it really means for the future of the company. Okay, let's just rip the Band-Aid off and start with the number that really shocked Wall Street. A GAAP earnings per share miss of 51 cents. Now, to put that in perspective, the consensus was looking for a loss of just a penny. Instead, the company reported a loss of 52 cents. That is a massive deviation, and it immediately set a really cautious tone for the entire report.
So this brings us to the big question, right? The core puzzle of the quarter. How on earth can a company add millions of new streaming subscribers, which is a great sign of growth, and yet miss its earnings estimates so badly? That's the riddle we're going to solve in this breakdown. To even begin to understand that puzzle, we have to look at the headline numbers. And let me tell you, this wasn't a clean beat or a clean mess. It was a truly mixed bag that tells a much more complicated story. Now, what's so interesting here is the contrast. You can see revenue came in right at $8.15 billion, which is fine. It's exactly in line with what everyone expected. But right below it, you see that huge GAAP EPS miss we just talked about. And then you get the bright spot, Paramount Plus adding 5.9 million net subscribers, a really solid beat. This table just perfectly illustrates the conflicting signals the market had to grapple with. So the most important thing to get is that Paramount is basically running a two-track race. It's this internal battle between the future of the company, streaming, and its past, the legacy media business. And this quarter just put that race into stark relief. So on one track, you've got the growth engine. Their direct-to-consumer or streaming business saw revenue jump a very healthy 17% year over year. This is the story management wants you to focus on, the momentum, the future, the clear proof that their big bet on streaming is gaining real traction. But then you look at the other track, and you see the legacy businesses, and they're going in the complete opposite direction. TV media revenue was down 5%, and the filmed entertainment studio segment was down a pretty steep 19%. This is the painful reality of cord cutting and a soft ad market hitting their most profitable segments and hitting them hard. These are the cash cows that have funded the company for decades, and they're shrinking. And this chart really shows you why those declines matter so much. Even with that impressive 17% growth, streaming is still the smaller piece of the total revenue pie. It's the legacy businesses, TV and film, that still make up the bulk of the company's sales. So when they shrink, it puts immense pressure on the overall bottom line, which goes a long way to explaining that big earnings miss. But, that legacy decline is only half the story. To understand why management is still optimistic and why investors haven't totally given up, you have to come back to the one number that did impress. Adding 5.9 million Paramount Plus subscribers in a single quarter, bringing the total to nearly 80 million. That's a huge achievement. It proves the content is working. Now, this split between the good news and the bad news created two very different narratives. You had the story that management was telling on their earnings call, and then there was the story the market actually heard. So how did this all play out? Well, management was focused on the positives. Hey, look at the undeniable streaming momentum. The losses in that segment are actually getting better. We're reinvesting in our huge franchises. But the market zeroed in on the negatives, that massive earnings miss, what they saw as pretty soft forward guidance, and they basically adopted a very cautious show-me stance. They want to see actual profits before they're going to buy into this turnaround story. Speaking of that forward guidance, let's take a closer look at what the company is signaling for the near future and the challenges that are still on the path ahead. So here's the Q1 guidance that got investors a little worried. Revenue is expected to be about what people thought, but the forecasts for adjusted OIBDA and, maybe more importantly, a negative free cash flow that signal that the financial pressure isn't letting up anytime soon. This is really the pain part of their big transition. Management was also pretty upfront about the specific headwinds they're facing. The traditional TV business is still soft, the film studio is in what they're calling a rebuild year after a few duds, and they're actively getting rid of some low-quality streaming subscribers from cheap bundles, which is gonna hurt the growth numbers in the short term. So, let's put it all together. What's our take on all this? Here's our analysis and what we're gonna be watching for heading into the next earnings call. We are initiating coverage with a market perform rating. The story here is just perfectly balanced on a knife's edge. You have this strong, undeniable growth in streaming, but it's being canceled out by the erosion in their legacy media and a really weak near-term profit outlook.
Until one of those forces clearly wins, we think the stock will probably just perform in line with the broader market.
Looking ahead, here are our specific predictions for next quarter. First, Paramount Plus subscriber growth is going to continue. That'll validate their streaming strategy. Second, that legacy revenue decline will probably stick around in that 5 to 10% range. And third, the stock's day-to-day moves will be extremely sensitive to any and all M&A rumors, especially anything about a potential Warner Brothers Discovery deal.
This quote really just nails the whole investment case right now. This stock is caught in a tug of war. You've got two ways this can play out. The fundamental turnaround, that's a slow grind. It could take years. But a potential merger or an acquisition, that could unlock value almost overnight. And that tension is what's defining this stock right now.
So what's our outrageous but plausible trade idea? We call it the M&A straddle. Look, this is a pure volatility play. You buy a long-dated call option, that's a bet the stock will go up, to capture that massive upside if an acquisition gets announced. At the same time, you buy a long-dated put option. That's a bet the stock will go down to protect yourself if a deal falls through and the stock reprices on its weaker fundamentals. The goal isn't to predict the direction, but to profit from a big move either way.
And as always, this is not financial advice.